Hello traders, it's December Wednesday the 11th. This is John Kicklighter, Chief Strategist for DailyFX.com, here with your FX market wrap-up for the past 24 hours of trading and an outlook for what we can expect in the 24 hours ahead. Now, it looks like the market conditions that we typically assume or expect with December are certainly setting in. We are seeing a significant drop-off in activity levels, measured through volume and volatility, as well as the more traditional or trader-friendly ATR figures. But we're also seeing that a lot of the prevailing trends, some of the strong ones like the Euro USD and the yen crosses, have started to pull back a little bit. This is one of the negative side effects of losing participation. You lose momentum, as well as see a reduction in swings for those medium-term breakouts. Now, we can see a lot of this price action pullback in many of the majors. The US dollar was a notable exception with a big move, or relatively big. This actual drop was less than 0.3%. So in fact, when we look at the general activity levels of the US dollar, once again we're extremely quiet. While we have moved from that 70-point congestion pattern, that less than 0.3% move extends our period of inactivity, an exceptional period of very small movements from the US dollar. Expected during this period, but also still very unusual, particularly given the level of event risk that we are looking forward to next week in the Fed taper. Now, that taper concern is not stirring much in the way of price action from the dollar, nor is it moving risk trends to a meaningful degree either. So we have noteworthy fundamental themes, but catalysts are still beholden to the backdrop of market conditions, and market conditions traditionally through December are quiet. Now, we talked about the seasonality effects a number of times in these videos. I also actually focused today's Forex strategy video particularly on seasonality effects, but one that really should stand out in our mind, even if you just trade FX, this has a very prominent influence on even our FX trades. This S&P 500 average monthly volume and average monthly change tells us exactly the kind of conditions we should typically expect. And when we know these conditions, market conditions being one of the three major analysis types, along with fundamentals and technicals, it determines for us what the better probability trading approach is. Would I want to establish new and heavy meaningful trend trades right now, knowing that there's an exceptionally low volume typically during this period from risk themes, which the S&P 500 likes to reflect? No, that would not be the trading approach I want to take. Nor would I want to really look for those or have a bias towards a strong risk aversion theme based trade. Why? Because as you can see from this S&P 500 assessment, December is typically the best performance for capital markets that are risk sensitive, like this S&P 500 here. So, knowing this particular seasonality set is going to help us perform our analysis as well as establish trade setups, because there are a lot of trade setups that look otherwise fantastic. Technically speaking, the S&P 500, this congestion pattern here between 1775 and about 1815, a breakout from that would seem like a fantastic break potential, whether bullish or bearish. But momentum, the follow through, we know it's going to be truncated by the conditions that we have in volume and participation. Looking at something like the US dollar, this congestion into a breakout would seem a perfect opportunity for follow through. However, same conditions with momentum. We look at pairs, particular pairs that have great technical settings, like the Aussie USD, a trade that I have taken with a break of this descending channel, having bounced off of this very noteworthy rising trend line here. All right. And subsequently, it does have that former resistance treated as new support, and that's a further catalyst for a move higher. You also add in the positive risk bearing. You also add in the yield expectations and the yield itself. This is supportive of the Australian dollar, but my targets have been set relatively close. In fact, I already hit my first target this past session. Plus 70 pips, equivalent to the initial stop that I placed, and took half off, trailed the stop up to break even on the second half. So setting the objectives very, very close. Pound dollar, another great short-term break candidate. It was a break candidate at the beginning of the week. I had that break to the upside, moved to a multi-year high, and stalled promptly. Once again, we have congestion that can offer us a similar situation, either break bullish or bearish, but follow through is going to be our tripping point. So we use these market analysis and seasonality effects to establish a very important aspect of our trade. Not necessarily just the risk bias, which is typically this is good for risk positive sentiment, but also to establish our objectives, our trade forecasts, whether I should be placing a trade that I expect to last a week or 2 weeks into the holiday, and thereby can span hundreds of pips, or maybe one that is less than 100 pips and is meant to last only a couple of trading days. All right, so we are better able to establish the types of trading conditions that we are currently facing. Now, this is going to be interesting, because we do have a very substantial drop-off in volume, and it's actually expected to continue to decline through the rest of the month. In fact, that's another comparison I made. This seasonality effect actually does have some value to it. If you look at the seasonal effect figures that I had for the dollar or the euro dollar or the pound dollar, or sorry, the dollar yen, you would see from those figures that there isn't any consistency. That's to be expected. There isn't a seasonality influence for exchange rates specifically. But for volume on the S&P 500, this is an activity gauge. This is like measuring the possible swell and drop in volatility. Because participation, as there's a big influx of trades, you will get that volatility impact. And as we know, volatility is often a sign of bigger swings in price action. All right, that's why we consider the VIX index to be so closely related to volume, and subsequently we consider the volatility indexes fear gauges. All right, so looking at this, you can see something very clear and prominent, that we do have a pretty consistent performance in volume and activity level up until the first 10, maybe 11 days of trading of the month. After that, we have a noteworthy spike. Well, guess what we have coming up next week? In fact, approximately 1 full week from now, we have the Fed rate decision. All right. So if we are expecting a volume increase, which is in many ways a volatility increase, around the same time with the release of the Fed decision, which is garnering a lot of speculation as a possible taper timetable, perhaps there is a substantial movement we can get in risk trends and in dollar-based pairs related to this particular piece of data. All right. It's a good combination of factors, yet at the same time, it is the optimal scenario. And very rarely do we ever get the optimal scenario. So it's going to be some level likely of lesser impact, lesser influence. But you do see that this interest and this last gasp of volume through the end of the year offers us a great opportunity. All right. But it's still a week away. So we have to keep that in mind. In the meantime, in the lead up to the event risk next Wednesday's FOMC rate decision, we have to play the hand that is dealt to us. There isn't necessarily a lot of volatility. In fact, this past session was particularly quiet. You didn't have much in the way of major pieces of event risk. The Draghi speech failed to generate a lot of activity. The Chinese data, as it typically seems to be, whether accurate or manipulated, was very close to the expectations. The Portugal economic forecast was improvement. We had the small business survey, which is important to hiring trends in the United States, was an improvement. You had GDP estimates from the NIESR was an improvement for the UK. All right, so generally positive data. in the upcoming 24 hours, we don't necessarily have a lot of high-level event risk, with the exception perhaps being the RB&Z rate decision, though expectations are relatively low for a change in policy here. There's always the possibility that there can be a rate hike, or the Governor Wheeler can actually pull back from his aggressive hawkish expectations. The market's still pricing in approximately 100 basis points worth of tightening over the coming year. Will those expectations change? Because we have seen some significant buoyancy come to the New Zealand dollar because of it. And perhaps if we see a disappointment, we might see the higher yielding carry currencies start to pull back, like the Kiwi yen or the Kiwi dollar. Because remember what has happened to the Aussie dollar in that same period. While it's tracing out a similar path, you have seen the Australian dollar suffered far worse because its interest rate expectations have suffered far more. That's why we have seen the Aussie Kiwi drop back to multi-year lows. All right, this would be particularly good to play this pair if we see any kind of change in interest rate expectations. This Aussie Kiwi is a perfect pairing, especially for a dovish outcome from the RB&Z. Now, dovish does not necessarily mean they will cut rates. That's not going to happen. Nor does it necessarily mean that they're going to completely banish any expectations of a rate hike. However, if they start to push back the timing of that first rate hike or diminish the size of the rate hikes over the coming year, that will have a material impact on the Kiwi. So the Kiwi dollar is certainly worth our time. You have your opportunities for a dovish outcome. You have also your opportunities for a hawkish outcome. Pound Kiwi and Euro Kiwi are certainly good options, particularly the Euro Kiwi as you see this tight wedge forming. You can also go for the yield providers like the Kiwi yen and the Kiwi dollar, but you have to be careful because unless you have confluence and capitulation by risk-based trends and the yen crosses and